Welcome to the deep dive. Today, we're tackling a really critical transition point for so many successful people, especially in fields like real estate, moving from being that star solo performer to, well, building something bigger, systemic growth.
Exactly. And we've got this fascinating collection of sources.
Mm.
I mean, it runs the gamut from, behavioral psychology, organizational stuff, right through to commercial real estate finance, even economic history. It's quite a mix.
It really is. So, our mission today is to pull out the threads, find those high leverage principles that connect all this. We want to build a kind of roadmap for you, the listener, on how to make that leap. How do you go from me to we effectively?
We're looking for those actions, those core ideas that give you the most bang for your buck, so to speak. The things that really drive scaling, particularly, as you mentioned, for someone maybe thinking about building out a team, say, in real estate.
Okay, let's jump right in. For anyone in a high volume business, especially sales like real estate, there's a foundation you need. The
Mhm.
sources actually boil it down quite nicely to what they call the 3 Ls.
That's it, the 3 Ls: leads, listings, and leverage. Leads and listings, well, those are your bread and butter, right?
Yeah.
The engine's input and output. Everyone gets that.
Sure, those are the metrics people track.
But the real key, the thing that separates the top producer who hits a ceiling from the leader who builds a scalable business, is mastering leverage.
And here's where the sources give some pretty specific, maybe even counterintuitive advice. When you, as that top agent, are maxed out, totally swamped, the first hire isn't another salesperson.
Right, it's administrative support talent first.
That feels wrong to a lot of high performers, doesn't it? You want someone else bringing in deals.
It does. Because the instinct is hire more revenue generators.
Hmm.
But think about the math just for a second. If you're the top agent, maybe your time on core tasks, negotiating, getting listings, is worth, say, $200 an hour.
Okay.
But you're spending maybe 10 hours a week on admin, paperwork, scheduling,
Mm.
stuff that could be done for, I don't know, $30 an hour. That's a $170 per hour opportunity cost right there. You're losing money by not delegating.
So hiring that admin person actually multiplies your productivity. It frees you up to do more of the $200 an hour work.
Precisely. It creates capacity at the top. That's the first essential step to real leverage. If you're serious about scaling, about building that team, you have to get the non-core tasks off your plate.
Okay, but scaling isn't just about hiring an assistant, right? It's a bigger shift. The sources talk about a psychological change being necessary. It's about identity.
Yeah, this is deep, but really important. The idea is that your behavior, what you consistently do, flows from who you believe you are, your identity.
Hmm.
Give me an example. Well, the classic one is voting. People who see themselves as being a voter as part of their identity are much more likely to actually vote than someone who just thinks, I should probably vote.
Ah, okay.
Yeah.
So to change your actions long term, like building systems or leading a team.
You need to start seeing yourself as a leader, as a system builder, not just a top salesperson. You internalize that identity.
And this connects to habits, I assume. Building the habits needed for scaling. The sources mention the third law of behavior change: make it easy.
Absolutely. Forget complex planning initially. Focus on practice, repetition.
Practice over planning.
For habit formation, yes. Take prospecting, or maybe just using your CRM consistently. Don't spend weeks designing the perfect system. Start by practicing entering one contact every single day. Make the action itself frictionless.
So it becomes automatic over time.
That's the goal. It's the number of reps, not the calendar days, that builds the habit. Making it easy makes the reps happen.
You know, this makes me think about something else. The sources highlighted this mismatch between how we're wired and what modern success requires. The whole delayed return environment idea.
Oh yeah, that's fundamental. We build systems, we invest, we train team members today, but the real payoff, that might be months, even years down the line.
But our brains didn't evolve for that.
Not at all. We evolved in an immediate return environment. Hunt food, eat food, find shelter, be safe now. Our brains crave that instant feedback, that immediate reward.
Which makes sticking with long-term system building work really hard. It feels unrewarding day to day.
Exactly. And that's precisely why having solid daily systems, like that admin support taking tasks off your plate, is so crucial. It provides little wins, little bits of immediate feedback, checking off tasks, seeing your calendar clear up that help bridge the gap psychologically. It makes the delayed reward feel more achievable.
Okay, so systems help bridge that gap. But systems only work with accountability. This leads us to that 12-week year model mentioned in the sources. How does that tackle this problem?
The brilliance of the 12-week year is that it basically hacks our tendency to procrastinate. annual goals. Psychologically, they feel too far away. Oh, I've got plenty of time. I'll catch up in Q3.
We've all done that.
Right. But shrink the horizon to just 12 weeks, and suddenly there's urgency. You can't afford a bad month, maybe not even a bad week. It forces you to confront execution or lack thereof now.
So execution becomes a daily and weekly focus, not quarterly.
It has to be. You plan in 12-week blocks, but you execute daily.
That sounds intense, though, keeping that pace up, 12 weeks at a time, multiple times a year. How do you sustain that, especially if you're leading a team trying to do it?
And you need fuel. Serious fuel. And sources are really clear on this. You need a compelling vision.
Not just make more money.
Definitely not. It has to be bigger than that, something you connect with emotionally, something that represents a future reality that's worth the struggle. Why are you building this team? What impact will it have? What kind of life will it enable for you and them?
So when things get tough, when a deal falls apart or a system breaks,
That vision pulls you through. It provides the why that justifies the effort and the resilience needed to get back up and execute the very next day. Without it, the model just burns people out.
let's talk about accountability itself. It often has this negative vibe like blame or punishment. How do you reframe that when you're building a team, scaling up?
You have to shift the perception entirely. It's not about blame, it's about ownership. Owning your actions, owning the results, good or bad.
And the leader has to set the tone.
Absolutely. A leader who models accountability doesn't point fingers when something goes wrong.
Yeah.
They say, okay, this happened. What did we learn? What process needs fixing? How do we prevent this next time? It's forward-looking, solution-focused.
How does that translate operationally, day to day, week to week?
Daily execution is key, but it needs that weekly rhythm for review and planning. This is where the sources talk about weekly accountability meetings, or WAMs.
Not just another team meeting.
No, definitely not. It's structured, usually Monday morning, maybe 60, 90 minutes. You look purely at the execution metrics from the past week against the plan. Did we do what we said we'd do? What worked, what didn't?
So analyzing the data.
Yes, analyzing the data, identifying bottlenecks or breakdowns in the system, not blaming individuals. And then crucially, you finalize the plan for the next 7 days. What are the absolute must-do actions this week to move us towards our 12-week goals? It keeps everyone aligned and focused on execution.
Okay, that makes sense. Let's shift gears a bit to the financial nuts and bolts of scaling, especially in real estate investment, which often goes hand in hand with building a brokerage or team. The sources offered a very specific tool for acquisitions, the max purchase price formula.
Oh, yes, the investor's best friend. Or should be. This formula is all about imposing discipline before you even start negotiating. It takes the emotion right out of it.
Remind us what it is again.
Simple but powerful. ARV, that's after repair value, minus rehab costs, minus fixed costs, like holding costs, closing fees, minus your desired profit equals your max purchase price.
So you work backward from the end result.
Exactly. Let's say comp show a flipped house will sell for $300 K. You estimate $50 in rehab, $15 in fixed costs, and you absolutely need a $45K profit to make the deal worthwhile.
Okay.
You do the math. $300 K is $50K, $50K, $45K. If it's $190K, that's your number, your absolute maximum offer. If the seller wants $200, you walk, period.
It forces you to prioritize profit, not just doing the deal or doing the rehab.
Precisely. And think about what that discipline implies. Where are you going to find deals that fit that tight formula?
Probably not on the open market, the MLS. The competition usually bids those margins away.
Right. So the formula implicitly demands that you develop superior skills in finding off-market deals and in negotiation. You need to find opportunities others aren't seeing or be able to negotiate prices others can't get. It forces you to level up your sourcing and negotiation game.
That need for better deals and creative approaches leads nicely into some advanced strategies the sources mentioned, like the master lease option, MLO. How does that help with scaling, especially with limited capital?
The MLO is fascinating. Think of it as a commercial rent-to-own, but for an entire income property, like an apartment building. The investor becomes the master tenant.
So they don't own it yet.
Not legally, no.
Yeah.
But they gain control. They manage the property, collect rents from the subtenants, pay the bills, handle maintenance, and usually for just an upfront option fee, which is way less than a down payment.
And you mentioned the triple net structure being common here. What does that mean for the investor taking the MLO?
Triple net, often written NNN, means the tenant, in this case the MLO investor, is responsible for the three big operating expenses: property taxes, property insurance, and maintenance repairs. The original owner just collects their master lease payment, essentially becoming passive.
So the investor takes on all the operational burden and potential upside from improving operations.
Correct. And crucially, legal title doesn't transfer until the investor exercises their option to buy, potentially years later. This defers the big capital gains tax event for the seller and allows the investor to control a large asset with relatively little cash down. It's a powerful leverage tool for scaling a portfolio.
Okay, but creative financing isn't without risks. The sources had a strong warning about seller financing when there's an existing mortgage involved, the wraparound mortgage.
Yes, extreme caution is needed here. Wraps are risky because virtually every mortgage has a due on sale clause.
Explain that.
It's standard contract language. It says if the borrower sells or transfers any interest in the property without the lender's permission, the lender can call the entire loan due immediately, demanding full repayment right now.
So doing a wrap means you're essentially hiding the transfer from the original lender and hoping they don't find out.
Pretty much. If they do find out, it could trigger that clause, leading to foreclosure if the balance can't be paid. That's why the sources strongly suggest seller financing is safest on properties owned free and clear. No existing mortgage, no due on sale risk.
Good advice. Scaling is about managing risk, not ignoring it. Now, for larger deals, the kind you get into when scaling significantly, lenders look hard at specific metrics. Let's talk DSCR, debt service coverage ratio.
Like DSCR is critical for getting financing. It measures the property's ability to pay its mortgage. The calculation is net operating income, NOI, divided by the total mortgage payment, debt service.
Simple ratio. What's the significance?
Well, anything below 1.0 means you're losing money each month. The property isn't generating enough income to cover the mortgage. Above 1.0 means positive cash flow.
But lenders want more than just breaking even, right?
Oh yeah, they want a cushion. If vacancies tick up or expenses spike, they still want that mortgage paid.
Yeah.
So typically, commercial lenders look for a DSCR somewhere in the 1.2 to 1.3 range, maybe even 1.25 as a minimum.
Meaning the property's income needs to be 20–30% higher than the mortgage payment.
Exactly. So for you, the investor trying to scale, boosting your NOI through smart management before you go for financing is key. A strong DSCR gets you better loan terms or even just gets the deal approved.
Okay, the other big metric, often misunderstood, cap rate, capitalization rate, NOI divided by purchase price.
The classic quick check for investment property value. But the potential for misinterpretation?
Because higher isn't always better.
Definitely not. You might see a property listed at an 8% cap rate in a declining area versus a 6% cap rate in a booming neighborhood with strong job and rent growth. Which is the better investment?
Probably the 6% cap rate in the growing market.
Likely, yes.
Okay.
Because the cap rate is just a snapshot of current income relative to price.
Yep.
It tells you nothing about future potential.
So you need context.
Context is everything. What are the market trends? Job growth, population shifts. Is the property currently underperforming compared to its potential? A lower cap rate in a great market might signal higher future appreciation and income growth, making it a much better long-term play than a high cap rate in a stagnant market. Don't just chase the highest number.
Makes sense. Now, scaling also means thinking long-term wealth, and taxes are a huge part of that. Let's touch on cost segregation.
Cost seg. A fantastic tool, but often misunderstood. It's about accelerating depreciation, not getting extra depreciation.
Explain the difference.
Okay, normally a residential building gets depreciated over 27.5 years, commercial over 39. A cost segregation study involves engineers identifying parts of the building that aren't structural and can be depreciated faster.
Like what?
Things like carpeting, special lighting, cabinetry, appliances, even certain types of plumbing and electrical landscaping, parking lots. These get reclassified into shorter depreciation categories, 5, 7, or 15 years typically.
So you take bigger depreciation deductions now in the early years of ownership.
Exactly, which creates larger paper losses that can offset your rental income or potentially even other active income depending on your tax situation. It boosts your immediate cash flow by reducing your current tax bill, freeing up capital you can use to, well, scale faster.
Very powerful. And then there's the cornerstone for deferring taxes long-term, the 1031 exchange.
The like-kind exchange. This is how real estate investors can trade up properties over their entire careers without paying capital gains tax along the way. You sell investment property A and roll all the proceeds into buying investment property B.
But there's a catch. The timelines are incredibly strict.
Brutal is the word, non-negotiable. From the day you close the sale on the property you're selling, the relinquished property, you have exactly 45 calendar days to formally identify potential replacement properties.
Identify, not buy.
Correct. Just identify them in writing. Then you have a total of 180 calendar days from the original sale date to actually close on the purchase of one or more of those identified properties.
And there are rules about value, too.
Yes, to fully defer all the tax, the purchase price of the replacement property must be equal to or greater than the net selling price of the old one, and you generally need to reinvest all the cash proceeds. Miss a deadline or mess up the value rules, and the tax deferral disappears. Poof! The gain becomes taxable in that year.
High stakes. Okay, one quick tax note on short-term rentals, which are obviously huge now.
Right, this is interesting. If you're running a short-term rental, like an Airbnb, and you provide substantial services, think hotel-like services.
Daily cleaning, maybe providing meals, or concierge-type help.
Exactly. If you materially participate and provide those kinds of services, the income might not be treated as passive rental income. It could potentially be treated as active business income.
And the benefit there.
It might qualify for the 20% pass-through deduction under Section 199A, which was part of the 2017 tax changes. That's a significant potential tax break compared to standard rental income. Worth looking into if you're heavily involved in managing your short-term rentals.
Okay, great financial points. Now, let's pivot back to the human element needed to make all this work. Sales and negotiation. You can have the best financial model, but if you can't sell or negotiate well, the sources mentioned the myth of sales volume.
This trips up so many successful agents trying to scale a team. They get addicted to the idea of high volume. Sign everyone, chase every lead.
Sounds busy, sounds successful.
It sounds busy, but it can be ruinous. What happens is they get completely bogged down servicing all these clients, many of whom might not be well qualified. They spend all their time on follow-up and transaction coordination.
And they stop doing the one thing that built their success in the first place.
Prospecting. Exactly. The engine shuts down. Prospecting generates future business. Follow-up manages current business. If you start prospecting because you're too busy, your pipeline dries up eventually, even if you're closing deals today.
So the antidote to this is better qualification.
Ruthless qualification. You have to become expert at separating the serious prospects, the ones ready, willing, and able to transact soon, from the tire kickers. A huge volume of low-quality leads is actually worse than a smaller volume of high-quality leads because it wastes your most valuable asset, time.
Especially the leader's time when building a team.
Absolutely. That time needs to be focused on high-leverage activities. Training the team, strategic planning, negotiating big deals, and yes, high-level prospecting, not chasing dead-end leads.
And when you do have those qualified leads, the follow-up needs to be smart. The source is stressed, no generic check-ins.
Please, no more just checking in emails or texts. It adds zero value. Follow up with value.
Like what?
Send them a relevant article about the neighborhood they like. Tell them about a price reduction on a property that fits their criteria. Share market stats that support their decision-making. Give them a reason to appreciate hearing from you. Position yourself as a resource, not a pest.
That focus on value and efficiency carries over into presentations too, doesn't it? Specifically, listing presentations. The advice was, shorter is better.
Counterintuitive again, maybe, but the data suggests yes. The longer an agent takes on a listing presentation, the more likely the commission gets negotiated down, the seller pushes for a higher unrealistic price, and the agent's profit margin shrinks.
Why do you think that is?
A long presentation can signal insecurity, or it invites nitpicking and overanalysis. A concise, confident presentation that clearly demonstrates expertise, a solid marketing plan, and a track record. That commands respect. It says, I know what I'm doing, let's get to work. It often leads to better terms for the agent.
Okay, let's get into some advanced negotiation psychology. This stuff is fascinating. The sources say, stop trying to get people to say yes, focus on no.
It flips the script, doesn't it? We're trained to think yes is the goal, no is failure. But in negotiation, no is often just the start.
How so?
No often
Right.
doesn't mean never. It means not yet, or I'm uncomfortable, or I don't understand. When someone says no, they feel like they've asserted control, paradoxically making them more open to listening afterwards. Accepting the no calmly without reacting defensively is key. It signals you're listening and ready to understand their real objection. No is the beginning of the real negotiation.
Okay, so you get the no. What's next? The sources talked about calibrated questions.
Right. These are open-ended questions designed to make the other person use their brain to solve your problem. They're non-confrontational.
Examples.
Instead of saying your price is too high, you might ask, how am I supposed to make that work? Or this deadline is very tight. How can we collaborate to meet it? Or simply, how can I help make this better for us?
Ah, so you're not accusing them, you're presenting a problem and implicitly asking for their help in solving it.
Exactly. You're engaging their intelligence. They start thinking about your constraints. And often, the solutions they come up with naturally move things closer to your desired outcome. It feels like collaboration, not conflict.
Very subtle. And to make all this work, you need trust. The sources mention using the authority principle by kind of arguing against yourself.
Yeah, it's about establishing credibility through honesty, specifically by admitting a minor flaw or downside first,
Why would you do that?
because it makes you seem more trustworthy. If you're willing to point out a small negative, the big positives you mention afterwards become much more believable. The classic example is Avis Rental Cars. We're number two, we try harder.
They admit the disadvantage, being number two, to make the advantage, trying harder, more credible.
Precisely. So in a negotiation or a sales pitch, maybe you acknowledge a small risk or a minor inconvenience in your proposal up front. That builds trust, so when you highlight the major benefits, your team's unique expertise, your faster process the client is much more likely to believe you fully.
Okay, let's zoom out a bit and connect these scaling principles to the broader economic context from the sources. How does efficiency in business relate to market dynamics?
Well, think about that history of retail competition, like A&P versus Walmart. The source pointed out that market leadership often boils down to achieving the lowest costs and reflecting that in lower prices. The company that figures out the most efficient operating model tends to win over time.
And the overall economy benefits from that efficiency.
Right. So for you, scaling your business, maybe building that real estate team, you need to be constantly asking, where can we be more efficient? How can we lower our cost per transaction or cost per lead? That administrative leverage we talked about, that's a cost efficiency play, using tech effectively. Same thing. It's about building the most competitive operational structure.
This focus on fundamentals reminds me of the point about long-run stock investing, too. What drives returns over time?
The sources simplified it down to two core things: the dividend yield when you buy the stock, and the future growth rate of earnings and dividends. That's basically it.
Even if companies don't pay dividends now.
Yeah, if they retain earnings, the assumption is they're reinvesting that money to fuel future earnings growth, which should eventually lead to a higher stock price or future dividends. It's about the initial yield plus the growth.
And you can see the parallel to real estate, right? The cap rate is like the initial yield.
And the long-term appreciation and rent growth is the growth component, which, again, ties back to why analyzing the market's growth prospects, job growth, etc., is just as important, if not more so, than the starting cap rate.
It all interconnects. And market growth is often tied to urban trends, like gentrification. The sources mention the Great Inversion.
Yeah, the historical pattern was wealth moving out from city cores to suburbs. But more recently, we've seen this inversion. Highly educated workers, the creative class, moving back into cities, seeking amenities, walkability, shorter commutes.
Which drives up property values in those areas. Good for investors who got in early.
Definitely. But it also creates significant social and economic challenges, displacement concerns, affordability crises. So for the scaling investor or team leader operating in these areas, you need to see both the opportunity, high growth potential, and the potential risks. Increased regulation, community opposition, maybe rent control measures down the line. It adds complexity to the market analysis.
Finally, we need to acknowledge some broader context from the sources, maintaining impartiality as we report it. There were points about global issues and media influence.
Yes, the source material included a finding that nearly 40% of the world's women live in countries that are lagging on gender equality metrics, and that disparities among women are growing based on things like family status. This just underscores the complex global landscape influencing economies and workforces.
And there was also a reference to the reporting during the Watergate era.
Right. It highlighted how investigative reporting, using strains of evidence and deduction based on deep source knowledge, constructed a powerful narrative of White House-directed espionage, even before all the facts were officially confirmed or denials were fully overcome.
What's the takeaway for a leader today from that?
It's a reminder, really, that narratives matter immensely. How information is framed, how evidence is interpreted and presented, shapes public perception and market sentiment. As a leader building a brand and a team, you need to be aware of the narratives surrounding your industry, your market, and even your own business, and manage your communications strategically.
So wrapping this all up, we've gone through a lot from the psychology of identity to the math of DSCR. For you, the listener, aiming to build something beyond yourself, what's the core message?
I think it boils down to mastering systems. Leads, listings, leverage, that's a system. Financial formulas, accountability structures, those are systems.
Yeah.
Even negotiation tactics are part of a system for human interaction. Scaling means shifting from relying on your personal talent to relying on robust, repeatable systems.
And adopting principles from all these different fields we touched on.
That's the highest leverage skill, I think, being able to see the connections. Applying a psychological principle to your sales process, using a financial metric to drive operational efficiency, understanding economic history to make better market bets. It's about becoming a system architect, not just a technician.
The sources had a really potent final thought that leaders often mistakenly think they are the deal, the source of all value. But maybe a better framing is that the leader is merely the steward of the dreams of the people they lead.
That reframes everything, doesn't it? It shifts the focus from your ego to enabling your team's success.
So the provocative question for you listening today is, if you truly want to scale, what specific systems will you implement this week? Maybe starting with that crucial admin hire to ensure your team's success is built on achieving their goals and dreams. Because ultimately, their success will be the engine driving the massive scaling of your own vision.